There is big news in the traditional finance world, and that's the change of the Federal Reserve chair. So how will this impact asset prices? How will monetary policy, rising and falling interest rates, have an impact on our stocks, on our crypto, on our bonds? In this video, we're going to look behind the popular narratives. We are going to look at the actual data. Because once we dive a bit deeper, a change like this has a very different impact to what most people expect. Because once we dive a bit deeper, a change like this has a very different impact to what most people expect. Now let's start off with this chart here. It's a historical chart of the interest rate in green. So that's what the Federal Reserve is setting. And the inflation rate in red. That's the official consumer price index. The official numbers of how much the money is devaluing over time. Now I'm saying here the official numbers because I personally think that the numbers that are published with the consumer price index are underrepresenting of what's actually going on. I think that the value of our money goes down faster than what is officially stated. But that's besides the point of this video. One of the mandates of the Federal Reserve is to keep prices somewhat stable. And that's why we see those two lines moving somewhat in sync. When inflation rates are high, the interest rate moves up with it. That's called monetary tightening. That means it's harder to borrow money, it costs more, so less money will be borrowed, so there should be less money creation. That's the whole idea of a fractional reserve banking system. There's new money being created through credit, and that new creation slows down when interest rates go up. And that should then lead to a falling inflation rate. And that's also what subsequently happened. This is now the 1980s. And then subsequently the interest rate follows. The Federal Reserve had been hesitant to lower interest rates, at least relative to the officially measured inflation rates, but now inflation rates are coming back up again. And that's clearly because of the war in Iran. That's because oil prices are going up. Now, what does this all have to do with our assets? What does this have to do with stocks and crypto and bonds, etc.? Let's have a look at the real interest rate, at least officially measured real interest rate, right? So we look at what is the Federal Reserve setting the target interest rate at, and we compare that to the inflation rate. We calculate the delta between the two. What we get in excess of the inflation rate as interest rate, that's what's called the real interest rate. What we really get in purchasing power if we take the CPI as official measure. So we turn this chart into this chart over here. So interest rate minus inflation rate, that's the real interest rate. It's the same chart, just that this time we calculate the delta. The solid horizontal line, that's zero. That means we don't get anything by parking our money in short-term bonds. So the inflation rate is equal the interest rate. When this is above the solid line, then we get real positive returns. When this is below the solid line, then we are burning money by stashing our cash away into short-term bonds. Currently, we are pretty much bang on that zero level. Or in other words, the inflation rate is very close to the interest rate. Very likely though, the inflation rate will go up higher. And then we have again negative real rates. If of course the Federal Reserve decides not to then suddenly turn around again and raise interest rates. So that's fundamentally what's going on. Now what is this dotted line over here? That's the average value of the real interest. So let's remove the zero line again. As the average value, we tend to see 1.1% as the real interest. So on average, historically, since 1971, being risk off still compensated you by roughly 1.1% per annum. Again, if you believe the consumer price index. But why is this so interesting? It's interesting because it tells us really when we have periods of loose monetary policy versus tight monetary policy. When is the Federal Reserve moving their interest rates higher than they should be? When is the monetary base expanding very quickly, benefiting of course the people with debt? So that's people that build houses or take on debt in a business or maybe finance an LBO. Tight monetary policy is not great for debt takers, loose monetary policy is. But how does this impact asset prices? That's explained over here. So in theory, if we've got very high interest rates, we should have lower asset prices, because high interest rates means also we have to discount the future cash flows more. When we've got very low interest rates, then we have to discount those cash flows less, then asset prices should be rather high. So asset prices are simply the sum of the future cash flows, the present value of the sum of the future cash flows. So that's fundamentally how this works. This is what we might be getting in cash flows over time, but as time progresses, we have to discount those cash flows more and more. So $1 today is worth more to us than $1 in 25 years. And the higher the interest rate is, the more we have to discount that cash flow. That's why high interest rates are bad for asset prices. And so in theory, what we should expect is that when real interest rates are high, stock prices should go down. When real interest rates are low, stock prices should be going up. Is that what we observe in reality? Now what we've got here at the bottom, that's the S&P 500 relative to the money supply. So this looks at the stock valuation if the US monetary base, USM2, was not to expand by 6.8% per annum. Because that's what's happening in practice. There's more and more dollars floating around due to credit creation. And so really money, in my opinion, devalues by 6.8% per year. The only reason why the officially measured inflation rate is lower than that is because we have productivity gains. It's easier and easier for us to produce things over time. That technological progress is the delta between the 6.8% monetary expansion and the officially measured inflation rates that are rarely above those 6.8%, right? The red line over here, that's the officially measured inflation rate. But I'm digressing. We want to figure out if we've got very hawkish monetary policy, so when interest rates are high, when borrowing is expensive, are stocks actually going down? So we've got this period over here. This was a high interest rate period on average. And the S&P 500 relative to the US money supply actually went up by roughly 30%. Now this is real returns in the true sense. This is the S&P 500 relative to the money supply. So we are already calculating in the 6.8% monetary debasement. We are getting the 6.8% per annum plus the 30% extra real return during the span of 11 years, during a very hawkish period when real interest was very, very high. Now then we could take this period over here. This was clearly hawkish. We tended to be in negative real interest rates. If we wanted to, we could also start the period over here. During this time period where stocks should go up a lot because we are at very low borrowing costs, the S&P 500 rather tended to lose. So that was 4% over here. If you take this starting point, it's even more. It's 19 or 20%. We've got a time series here of 22 years. And even over such a long time period, a very loose monetary policy did not support the stock market sufficiently. Isn't that interesting? This is completely against the official narrative of traditional media. The CNNs of this world, they tell us when the Federal Reserve is very hawkish, we will see a crash in asset prices. When the Federal Reserve has very loose monetary policy, then everything should be going up. But we do not see this in the data, even if you look at very long time horizons. This is not just short-term fluctuation. This here on the left, that's 11 years. This here on the right, that's 16 or potentially even 22 years, depending on where you're starting this loose policy reference. In theory, in academia, this all makes sense. As in, if we do have very high interest rates, we might as well just park our capital and completely risk off assets and forget about the risk on assets, forget about the stock market. So there should be a capital shift from the stock market, say, to bonds. And so we should see, in theory, the stock market to go down versus the monetary base. In theory, in academia, this is what everybody tells us. I personally even studied all of this. I have a master's from Hong Kong in financial analysis and investment management. Discounting cash flows and getting the value of an asset based on that DCF method, that's what they tell us. But unfortunately, it doesn't work. It doesn't help to explain market dynamics. Let's have a look at TLT. That's a long-term government bond ETF. Now with bond ETFs, it should be even cleaner because here we do know the future cash flows. With the stock market, we could say, okay, this data might be very dirty because there's also business cycles. Maybe the expectations of future returns fluctuate. That's why we don't see the strong connection between real interest rates and stock price developments. But for bonds, this should not be the case. Now, this here is a long-term government bond ETF. And when we had very low real interest rates, so from here to here, we should actually see prices go up. It's not what we are seeing. Subsequently, real interest rates recovered again, but it didn't have any impact on bond prices at all. In theory, there would be a reverse connection here. Now, maybe as a reference point, we should just take nominal interest rates and not real interest rates. But even then, if we look at that connection, right? Hawkish monetary policy, interest rates are going up. Prices of bonds did not necessarily collapse. Then we had a crash in interest rates, and while bond prices recovered, they came back to reality very quickly afterwards again. Do we see a decline over here when interest rates are going up? Are bond prices declining? Not necessarily. And so the connection is extremely weak. Yes, we've got a decline of bond prices over here when things got hawkish, but then have they really recovered after interest rates went down again? No, they have not. People make so much fuss about interest rate policy. And now the traditional media is looking at the biography of the new Federal Reserve, try to anticipate where interest rates are going. But really, from an investment standpoint, real interest rates do not have that much of an impact on stock price developments or even on bond price developments. It's always the same. The money supply grows pretty predictably by 6.8% per annum. And so our playbook shouldn't change that much either. We should have debt that's cheaper than 6.8% per annum and then buy with that debt something that keeps its value. Be this gold, be this stocks, be this property. If we want to take advantage of this game of the devaluing US dollar, we have to have a lot of debt in US dollars, and ideally we are able to serve that debt very easily, but at the same time we don't pay much for the debt. The less we have to pay for the debt, the more we take advantage of the devaluation of the 6.8% per annum. That's why gold on average over the decades appreciates by 6.8%. That's why stocks appreciate by 6.8%. That's also why property tends to appreciate by that number, plus minus 1 or 2 percentage points per year, depending of course on demand and supply dynamics within the asset class. If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. If you want to know what I personally invest in, if you want to see my track record of trades, it's all public, it's all disclosed, it's over here. That's the link to the premium website. Feel free to check out the details. Thanks for watching and see you next time. Cheers.